All right, welcome to today's explainer. Look, if you've been spinning your wheels in the markets, kind of gambling on gut feelings, today is the day that all stops. We are delivering a definitive, rock-solid blueprint for day trading success. Let's dive right in. So it all really starts with one big, simple question, right? Why do most day traders fail? And let me tell you, it's not a lack of effort. Failure actually stems from a lack of a consistent strategy. It's that awful tendency to strategy hop, jumping to a totally new system the very moment a trade goes red. Or at worse, trading completely randomly without any actual statistical edge. So to fix this, here is the game plan for today. We're going to cover the consistency problem, identifying the master trend, mapping out supply and demand, the advanced RAIN footprint method, the triangle of success, and finally, your timing and session focus. Let's jump right into part one, the consistency problem and building a rules-based edge. Here's the deal. You have got to stop trading randomly. Seriously. To actually succeed, you need a strict rules-based system that you follow every single day. That's the only way to keep those emotional losses in check. So today's blueprint, it focuses entirely on price action, supply and demand, and order flow. No messy, lagging indicators on the screen, just pure chart analysis. This is how you finally take emotion out of the driver's seat. Okay, moving on to part two, identifying the master trend. This is our foundation. First things first, you absolutely have to know which way the market is going. And we do this by spotting major swing levels. Now, a major swing level is simply the top or bottom of an impulsive move, a move that violently breaks right through previous market structure. But here's the catch. It's vital to remember that a major swing level is only actually confirmed after a new higher high or lower low is formed. The mechanics here are super straightforward. An uptrend, that's just higher highs and higher lows. A downtrend is lower lows and lower highs. I know, it sounds basic, but you must strictly align your trades with this momentum. If the market is making lower lows, you are only looking for short positions, period. Which brings us to an absolute, non-negotiable rule. I call it the master trend rule. You always look one time frame up from your execution chart. So if you're taking trades on a 5-minute chart, you've got to identify your major swing levels and that master trend on the 15-minute chart. Trading the 1 hour, look up to the 4 hour. This just ensures you've always got that higher time frame momentum pushing at your back. All right, let's get into part three, mapping supply and demand. These are our key areas of interest. Once we've got that higher time frame trend locked in, it's time to map out our actual trading zones. Think of demand zones as periods of consolidation right before a massive upward move. Supply zones, those are consolidations before a huge downward drop. Large institutional players leave massive footprints in these specific zones. When price eventually returns there, it creates heavily discounted or premium levels where those big players are super likely to step in again. It's basically like marking wholesale zones on your chart where the big institutions go shopping. And here is the golden rule for actually drawing these zones. You're looking to identify the exact last candle right before that big impulse move broke out. You mark that candle. Also, try to look for zones that have at least 3 historical touches. That shows heavy respect by the market, giving you a really high probability area of interest. Next up is part 4, the RAIN footprint method for advanced execution. Think of this as the security system for our blueprint. Look, just because price hits your supply or demand zone doesn't mean you just blindly jump in, right? We need confirmation that the zone is actually going to hold. So we use an advanced footprint execution method called RAIN. That stands for reversal, absorption, imbalance, and non-belief. Let's break these down step by step. Step 1 is reversal. But to get this, you first need to know what a POC is. The point of control, or POC, is the exact price level within a given candle that had the absolutely highest traded volume. For a valid reversal, you have to wait for a signal candle to close in your trade direction. It needs the correct delta, so negative for shorts, positive for longs, and crucially, it must close below its POC for a short or above it for a long. Next up is absorption. This is when you see unusually high volume right at the edge of your zone, proving that big players are absorbing retail orders. Then we have imbalance, aggressive market orders hitting the tape right now. And finally, non-belief. If a candle closes right at its POC, it shows market uncertainty. Do not jump in. Just wait for a clear breakout of that POC before you even think about executing your limit order. All right, moving to part 5, the triangle of success, covering psychology and risk. Because having a strategy is just putting up the walls. Now we've got to put a roof on our blueprint. Here's the cold, hard truth. A great price action strategy, that is only 1/3 of the battle. The triangle of trading success is actually split evenly between your trading strategy, your risk management, and your trading psychology. Without strict risk management and rock-solid discipline, even the best strategy in the whole world will absolutely drain your account. Now here is the math that will literally save your trading career. You should never, and I mean never, take a trade with less than a 2-to-1 risk to reward ratio. Why? Well, because if you only win 50% of your trades, but your winners are twice the size of your losers, you are going to be highly profitable over a large sample size. This right here is exactly how professional traders mathematically guarantee their edge. And to protect that mathematical edge, you've got to follow some mechanical risk rules. First, place your stop loss about 10 to 15 pips beyond the recent high or low. That keeps you safe from sudden liquidity grabs or market fakeouts. Also, use the 3-trade rule. Sometimes the market's just incredibly choppy. You are allowed a maximum of 3 attempts on a valid setup. If you get stopped out 3 times, walk away, period. No revenge trading. Finally, part 6, timing and session focus. Executing the blueprint. Because look, a great setup at the wrong time of day is just a bad setup. Timing is absolutely everything. You want to execute strictly during the pre-London or pre-New York sessions. This is when institutional volume is at its peak, which means follow through on your setups is way more likely. On the flip side, avoid trading entirely after the New York session closes. The volume totally dies out, the market chops around, and your win rate will literally plummet. So to wrap up your core discipline rules, stick to one market. Seriously, just master its personality. Stick to one time frame. Stop constantly shifting around looking for a random reason to enter a trade. And most importantly, focus on being green at the end of the month, not every single day. You're gonna have red days, but with a 2-to-1 ratio and strict discipline, the math works out in your favor over time. Patience truly is a trader's greatest quality. I want to leave you with this thought today. No trade is the best trade. Trading is a game of statistics, not gut feelings. If the market doesn't perfectly align with your higher time frame trend, if it misses your zone, and if rain doesn't fully confirm it, you just sit on your hands. So ask yourself right now, are you ready to stop gambling and start executing like a professional? Follow these rules, master your edge, and we will see you on the next explainer.